Before we begin, there is an important clarification we need to make about the power of three, also known as AMD, especially when we relate it to proper Wyckoff methodology. The power of three was popularized by ICT, and the accumulation, manipulation, and distribution naming was simplified to make the concept easier to understand. Here at Lucro, we are students of Wyckoff methodology, and we even have dedicated content and a full course on this subject on the channel, so we prefer to use the correct Wyckoff nomenclature. The strategy itself does not change at all, only the terminology used to describe the phases. It is important to understand that during a consolidation, you never know in real time whether it will result in accumulation or distribution. A consolidation only reveals its true nature after the next phase unfolds. Because of that, labeling a range too early as accumulation or distribution can be misleading. The correct way to think about it is that consolidation is neutral until the market shows its intention through continuation or reversal. What changes is the probability based on context. In a bullish environment, consolidations tend to act as accumulation or reaccumulation before continuation higher. In a bearish environment, consolidations tend to function as distribution before continuation lower. This mindset keeps your expectations aligned with market structure, avoids rigid labeling, and allows you to apply the power of three with clarity, flexibility, and proper Wyckoff logic. The power of three is a trading pattern that breaks down price action on the chart into three major phases: consolidation, manipulation, and continuation. The first phase is a consolidation, which can later prove to be either accumulation or distribution, depending on what happens next. During this phase, price lacks a clear directional trend and often forms equal highs and equal lows, building liquidity and stop losses above and below the range, depending on the time frame. This consolidation can appear in different structures, and on higher time frames, it usually forms a well-defined range. The manipulation phase occurs when price moves away from the consolidation through what appears to be a breakout, but fails to follow through. In basic price action, when price breaks below a support level, that level often becomes resistance and pushes price lower due to trader behavior. Traders who previously went long see the retest as an opportunity to exit, while others see it as a chance to enter short. However, when price fails to continue and quickly returns back inside the consolidation range, this movement is classified as a fakeout. This action is designed to sweep liquidity outside the range and trap breakout traders. Once liquidity has been collected, price typically expands in the opposite direction. This final phase is what we refer to as continuation, and it is where trade execution takes place. As traders applying smart money concepts, the objective is to enter after liquidity has been taken and stops have been triggered. In simple terms, the power of three framework describes a sequence of consolidation, manipulation, and continuation, with accumulation or distribution only becoming clear after the continuation phase unfolds. Similarly, in a bearish scenario, the market forms a consolidation followed by a breakout to the upside, which engages liquidity above the equal highs. If price quickly returns back inside the range, this signals a fakeout, and the power of three pattern completes with a sharp continuation move to the downside. So, how do we enter a trade using the power of three pattern? We aim to enter trades after the manipulation phase is confirmed. First, price must return back inside the consolidation range, confirming the failed breakout. We then mark the candle closes that define the consolidation area. For entry confirmation, we need a clear break and close back inside the box. The stop loss is placed above the swing high, while targets are set at key levels ahead of price. There are situations where price expands aggressively and the initial move is missed. When that happens, we wait for a new market structure to form, and then look for a pullback to enter at a better price with a balanced risk-to-reward ratio. In other words, we focus on continuation trades after manipulation. aligning with the dominant direction rather than chasing price. If we look at this price formation from an intraday perspective, the daily candlestick would reflect this behavior clearly. Price opens, forms a high, moves to a low, and then closes strong. The objective is to capture the largest directional move within the intraday range, using the Power of Three framework. Now let us move to the chart and review some real trading examples. It is important to remember that this setup is not limited to a single time frame and works across both lower and higher time frames. In this example, we are analyzing gold on the 30-minute chart. The market is forming a clear consolidation range with repeated rejections from both the top and the bottom, signaling liquidity being built above and below the range, which can later resolve as either accumulation or distribution, depending on continuation. If we are bullish, the idea is to wait for manipulation below the consolidation lows to engage sell-side liquidity and then expect price to continue higher. If we are bearish, we look for manipulation above the equal highs to engage buy-side liquidity and then anticipate price continuing lower. In both cases, the consolidation itself remains neutral until the continuation confirms direction. Let us see how this plays out. Here, the next two candles break above the equal highs, engaging buy-side liquidity and trapping breakout traders who believe the level had been broken. When price returns back inside the consolidation range, the manipulation phase is confirmed. From this point forward, we look for a short entry aligned with the expected continuation. In this example, we have a clear opportunity to open a short position at the close of this candle, expecting price to push lower. The stop loss is placed above the swing high and the target is set at 2 times the risk. As price expands lower, the Power of Three sequence completes with a strong continuation move to the downside. It is important to understand that, like any trading concept, the Power of Three should not be used in isolation. It becomes far more effective when combined with other smart money concepts. For instance, if a higher time frame supply zone were present at this level, it would add strong confluence to the setup, increasing the probability of rejection. The same applies to higher time frame trend context. If price is already in a clear downtrend on the higher time frame, this short setup gains additional confirmation by aligning with overall market direction. This is why combining multiple concepts leads to more structured, consistent, and informed trading decisions. So trader, please remember that the Lucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.